Every trader faces this critical question: should I go all in or play it safe? Knowing when to trade big and when to trade small can make the difference between long-term success and devastating losses. This is where the concept of progressive exposure comes into play, a strategy that helps you gradually increase your risk as your confidence and market knowledge grow. In this guide, we'll break down exactly how to use progressive exposure to maximize your gains while minimizing risks. Start small when you're new or unfamiliar with the market. If you're just starting your trading journey or exploring a new market, the golden rule is to trade small. Cryptocurrency, stocks, forex, or commodities, all markets have unique behaviors and risks. Trading small helps you gain valuable experience and build a feel for market trends without exposing yourself to significant financial risk. By starting small, you also give yourself room to make mistakes, which are inevitable for beginners. For example, if you're new to crypto trading, start with small positions in stable coins like Bitcoin or Ethereum rather than diving into volatile altcoins. This ensures that even if your trades go south, the losses won't wipe out your portfolio. Over time, as you build confidence and understand how the market reacts to news, trends, and technical indicators, you can increase the size of your trades gradually. Increase exposure when you identify a high-confidence opportunity. Trading big is reserved for those rare moments when you spot a high-confidence opportunity. This typically happens after extensive research, technical analysis, and a clear understanding of the market environment. For instance, a major cryptocurrency might break out of a long-term resistance level, signaling the start of a bullish trend. High-confidence opportunities should be backed by strong fundamentals or technical patterns. However, even when trading big, it's important to limit your risk by setting stop-loss orders and not over-leveraging. A common mistake is betting your entire portfolio on a single sure thing. Remember, even the most confident trades can fail due to unforeseen circumstances. By trading big but managing your risk, you can take advantage of favorable market conditions without jeopardizing your financial stability. Use progressive exposure to scale up. Progressive exposure is a strategic approach to gradually increasing your trading position as the market moves in your favor. Instead of committing a large sum up front, you start small and add to your position as confirmation of your analysis unfolds. This reduces the risk of heavy losses if the market goes against you. For example, if you're trading forex and believe a currency pair will rise, you might start with 10% of your planned position. As the price moves in your favor and confirms the trend, you add another 20%, and so on. This method ensures you only trade big when the market proves you're right, reducing your exposure to potential losses. At the same time, it allows you to maximize profits by capitalizing on strong trends. Trade small during uncertain market conditions. Uncertainty is a trader's worst enemy. When the market is unpredictable, such as during major geopolitical events, economic crises, or erratic price movements, it's wise to scale back and trade small. High volatility can lead to sudden price swings that defy technical and fundamental analysis, making it difficult to make informed decisions. For example, during the COVID-19 pandemic, markets across the globe experienced unprecedented volatility. In such times, even seasoned traders reduced their exposure to protect their portfolios. By trading small, you preserve your capital and avoid emotional decision-making, which often leads to costly mistakes. Remember, it's better to miss an opportunity than to risk a significant loss in an unpredictable market. Diversify to balance risk and reward. One way to decide when to trade big and when to trade small is by diversifying your trades. Instead of placing one large trade, consider splitting your capital across multiple trades of varying sizes. This reduces the impact of a single bad trade on your overall portfolio. For example, if you're trading cryptocurrencies, you might allocate 50% of your capital to a high-confidence Bitcoin trade, 30% to a medium-risk Ethereum trade, and 20% to a smaller, high-risk altcoin trade. By diversifying, you can trade big on stable assets with strong fundamentals while experimenting with smaller trades in riskier assets. This approach ensures that you're always balancing risk and reward across your portfolio. Trade big when you have a defined exit plan. One of the key principles of trading big is having a clear exit strategy. Before you commit a significant portion of your capital to a trade, decide in advance where you'll take profits and where you'll cut losses. This helps you avoid emotional decisions and ensures you stick to your trading plan. For instance, if you're trading stocks and believe a company's share price will rise, set a target price for taking profits and a stop loss to limit your downside. A defined exit plan allows you to trade big with confidence, knowing that you've already accounted for potential risks. Without an exit plan, you're more likely to panic sell during market dips or hold on to losing positions for too long. Keep trading small during your learning phases. Even experienced traders go through learning phases when exploring new strategies, markets, or tools. During these periods, it's essential to trade small to minimize risk. For example, if you're learning how to trade options or experimenting with leverage, start with small positions until you fully understand how these instruments work. Trading small during your learning phases not only protects your capital but also allows you to focus on refining your skills without the added pressure of significant financial stakes. Once you've mastered the new strategy or market, you can gradually scale up your trades using progressive exposure. Trade big when the market aligns with your strengths. Every trader has unique strengths, whether it's spotting technical patterns, interpreting news, or understanding specific markets. Trade big when the market conditions align with your expertise. For instance, if you're skilled at trading breakouts, increase your exposure when you identify a strong breakout opportunity. Similarly, if you excel at fundamental analysis, trade big when a company or cryptocurrency releases favorable news that aligns with your research. By focusing on your strengths, you maximize your chances of success and reduce the risk of making costly mistakes. Trading big in your areas of expertise is one of the most effective ways to grow your portfolio over time. Leverage trading: when and how much to risk. Leverage trading allows you to trade big with less capital by borrowing funds from the exchange. While it can amplify profits, it also magnifies losses, making it a double-edged sword. Beginners should avoid leverage trading until they've gained experience and developed a solid risk management plan. If you decide to use leverage, start with low leverage ratios, 2x or 3x, and trade only when you're highly confident in your analysis. Use stop-loss orders to limit potential losses, and never risk more than you can afford to lose. Leverage trading should be reserved for seasoned traders who understand the risks and have a proven track record of success. Review and adjust your strategy regularly. Trading is not a one-size-fits-all endeavor, and your strategy should evolve based on your performance, market conditions, and personal goals. Regularly review your trades to identify patterns in your successes and failures. Are you trading big too often and suffering losses, or are you trading small and missing out on potential profits? Adjust your strategy to align with your findings. For example, if you notice that you're consistently profitable in trending markets but struggle during consolidations, focus on trading big during trends and scaling back during sideways markets. Continuous improvement is key to long-term success in trading. Knowing when to trade big and when to trade small is a skill that separates successful traders from the rest. By using strategies like progressive exposure, managing risk, and focusing on your strengths, you can navigate the market with confidence and consistency. If you found this guide helpful, don't forget to like, share, and subscribe for more trading tips and strategies. Let us know in the comments how you approach trading big versus trading small. We'd love to hear your insights.